Hey everyone, Will Ham here with 27T Financial. What we're introducing today is the video version of our 27T charted newsletter, where every month I take 3 charts and break them down, what they actually mean for your money in an easy to understand format. I want you to begin to understand what's happening beneath the headlines and the noise of the traditional and social media. This month, we're talking about 3 things that are all over the news right now: the conflict with Iran, the magnificent Test 7 tech stocks, and the SpaceX IPO. A lot of noises out there, so let's cut through it together and let's get into it. Okay, so first chart, and I want to start here because I know a lot of you have been watching the news and feeling uneasy about what's happening in Iran. Here's the thing I want you to understand. Markets and news cycles are 2 very different animals. The news cycle is designed to create urgency and emotion, where markets are designed to price in business impact. And right now, despite everything you're seeing on TV, the actual business impact of the Iran conflict on the broader US economy is pretty minimal. What we're showing here in this chart is the S&P 500's 1-year forward return after every major geopolitical event since the Korean War. The Cuban Missile Crisis, the Gulf War, 9/11, COVID-19, the Ukraine invasion, and now the Iran war. You know what the average was across all of these events? 14.2%. And the Iran war, which just started in February of this year, is already tracking at 10.2% positive growth since it began, right in the neighborhood of historical averages. Now, does that mean nothing bad can happen? Of course not. But what it does mean is that the panic selling, pulling out of your 401k, or moving everything to cash has historically been exactly the wrong move. Really, every time in history, the data, what we're showing you here today, doesn't lie. Moving on to the second chart, and this one is really interesting because it tells a story that I think actually is really encouraging, even though it might not look that way at first glance. So over the last several years, the stock market's performance has been dominated by 7 companies. You know them well: Microsoft, Meta, Tesla, Amazon, Apple, Nvidia, and Google, what's called the Magnificent Seven. And during that run, a lot of people, including a lot of smart people, have been worried. Why? When 7 companies are responsible for almost all of the market gains, it's a fragile situation. Now, let's look under the hood and see what's actually happening in 2026. Year to date, the Mag 7 has actually been a drag on the S&P 500. Microsoft down 29 points, Meta down 8, Tesla down 4. As a group, they've been mostly flat or negative. But here's the real interesting part. The S&P 500 is still up on the year. How is that? Because the other 493 companies in the index have contributed 522 points of growth. The rest of the market is carrying things forward. Now, why does that matter to you? Because it means that the market's foundation is actually getting broader and healthier. A market where 493 companies are contributing is far more stable than one where 7 are doing all the work. Your diversified retirement portfolio is built for exactly this kind of environment. I saved this one for last because I know a lot of people are thinking about it today. SpaceX. It's the hottest topic on Wall Street right now, and quite frankly, the excitement is real. The hype is loud, and I completely understand why you might be interested. Elon Musk, rockets, the future of space travel, but I want to show you something before you do anything with your money. And I think this chart is a really important illustration to show you. What we're showing is the 10 largest IPOs in history since 1999. We're talking about household names like Alibaba, Meta, Uber, Rivian, even General Motors and Snap. Companies that everyone was excited about leading up to when they went public. But what happened in the first 12 months after each of these IPOs went live is kind of surprising. Alibaba, down 30%. Meta, down 31.3%. GM, 36.6%. Rivian, 71.6%. And Uber, 21.1%. The average across the first year of all of these returns, negative 26.9%. Not a single one finished the year in a positive territory. Not one. Now, I'm not telling you SpaceX is going to be a bad company. It might be an incredible company. But the juice for everyday investors, typically the people that are watching this video, is almost never worth the squeeze when it comes to these mega IPOs. The people who make the money on IPOs are largely the insiders and institutional investors who got in before the public does. By the time this is available to you and to me, the best returns are usually already gone. Your retirement savings are better protected by a diversified, long-term strategy than chasing the most exciting story of the moment. It's not boring advice. That's what the data says. So let's bring it all together. The Iran conflict is scary in the news, but history shows that markets are resilient. The Mag 7, though stumbling, is actually a sign of healthy and broader markets. And SpaceX IPO is an exciting conversation, but historically, those IPOs have had a rough track record that could give everyday investors some pause. The theme this month is really simple. Don't let the noise make your decisions for you. Stay diversified, stay invested, and trust the plan. If you have questions about your accounts or you just want to talk through what's going on in the market, please reach out. And if you found this helpful, please share it with someone who might need a little extra help this month. I'll see you next month. Take care.